Global Finance, Topic 9B, Currency Futures by Lou Gaddis. The objectives of this podcast are to expose students to the use of futures contracts. We'll talk about the payoffs and profits of currency futures, the difference between a forward and a future, how financial managers use futures to hedge FX, and how futures are traded and margins calculated. To review from earlier lectures, a spot or cash transaction is a transaction in which there's near immediate delivery. So as you shop at a food store and you buy a gallon of milk, that would be called a spot or cash transaction where delivery is near immediate. However, if you were to buy currencies from a financial institution, say you deposit some money at a financial trading system, and you purchase some euros, the euros may be delivered in a little bit longer time period. However, that's still considered a spot or cash transaction. A forward transaction is a contract in which you agree upon all the terms of the purchase or sale, meaning the price, which we'll call the forward price, the delivery date or maturity of the contract, the quantity of the currency, and the delivery location. A futures contract is a forward contract. However, it's a forward contract that's traded on an exchange. And these forward contracts that are now called futures contracts are also tradable, meaning once you enter into a forward contract or on an exchange, this futures contract then can be traded to another party. Also, with futures contracts, there is definitely a margin requirement. Forward contracts may or may not have margins. So a forward contract is traded in what we call the OTC market, over the counter, meaning it's a network of banks and other financial institutions, brokers and dealers, all trying to facilitate trade. Whereas a futures contract is traded on an organized exchange, a physical location like the Chicago Mercantile Exchange, the CME, or the NYMEX, the New York Mercantile Exchange. Forward contracts, all terms are negotiable. Besides the currency pair, the price is negotiable, the delivery date's negotiable, the delivery terms are negotiable, however, and quantities are negotiable. In a futures contract, all these terms are standardized. The only choice is whether you buy or sell and what quantity. A forward contract is usually in indirect terms or usually the customary terms of the currency, so maybe it might be quoted in yen per dollar and dollar per euro. However, futures contracts are generally all quoted in direct terms, dollar price of the foreign currency, even for yen. A forward contract, you pay for it through the bid-ask spread. In other words, it's a higher price to buy and a lower price to sell. Futures contract, there is one price, however, you will pay a broker fee. A forward contract is considered to have counterparty risk, meaning that if you have a forward contract to buy or sell a currency next year, there is a chance that that counterparty may not deliver. On the other hand, if you have a contract with an exchange, the exchange facilitates the trade with another individual. However, your contract is with the exchange. Therefore, the exchange ensures that delivery happens. And there's never been a failure of an exchange or an exchange in the U.S. There's usually not a margin requirement for a forward contract, and there's always a margin for a futures contract. Also, with a forward contract, most of them result in physical delivery of the asset and are settled at maturity. Futures contracts, many are not held until maturity. It's not that you can cancel it, but you can trade it to another individual. And there's also a daily mark-to-market process for a futures contract. So here are some futures prices quoted in the Wall Street Journal. You might find these online or in Bloomberg, similar quotes. And we'll start here with the British pound. You can see that the pound is traded on the Chicago Mercantile Exchange. The quantity is 62,500 pounds. So each contract, if I say take a long position in one contract, I have a contract to buy 62,500 pounds. The December price, say opening price, was 176.50. So if I were to buy one contract at the opening on this day for December delivery, it looks like I would be committed to buying 62,500 pounds at $1.7650. We can see that the Japanese yen is also on the Chicago Mercantile Exchange. Each contract is for 12,500,000 yen, and they're quoted dollar per 100 yen. So when I see a quote of 0.8861, it's actually 0.008861 per dollar since it's per 100 yen. And the only reason to do that is so they don't have to show these zeros in all the quotes to save a little space. But if I were to invert this exchange rate, you can see the price is really 112 yen per dollar. Each euro contract traded on the Chicago Mercantile Exchange is for 125,000 euros. And you can see the settle price for that day for a December delivery is $1.2228. Meaning if I were to say long 4 contracts, I'm committed to buy 4 times 125, 500,000 euros at $1.2228 in December. And if I go to their website, you can see exactly the date of the contract maturity. It might be, say, the 3rd Friday of December. So suppose Dell has a 500,000 receivable they expect to come due in December. Now, if they don't hedge, they estimate the exchange rate could be anywhere from, say, 130 to 112. If they receive their 500,000 in December, say from the sale of computers, and they get 130 when they go ahead and sell the euros and bring them back to the U.S., they'll get $655,000. If the exchange rate goes to 112.25, they'll get $561,000. So you can see what we say they're long the euro, meaning they have a long exposure to the euro while they're sitting on this receivable. If the euro appreciates, they will gain. If the euro depreciates, they will lose. Now what Dell could do is they can go back to the CME, see that December delivery price is $1.2228. Each contract is for 125,000 euros, so they could take a long position in 4 of these contracts, in which they are now locked in to selling. I'm sorry, if they have a receivable, they actually want a short position in that contract, right? Because they are going to be receiving euros from, say, a vendor or some kind of contract. And they need a contract to sell the euros, so that we call that being a short position or a seller of the euro forward contract. So they're going to short 4 December euro contracts at the CME for 500,000 euros. And therefore, they are contractually obligated to deliver 500,000 euros at $1.2228. And now they are locked into getting a profit of 611,400. So they are no longer exposed to the euro. They had a balance sheet long position in the euro, which they have then offset by taking a short position in the forward. Dell will have to post a margin for that position, right? The initial margin from previous lectures was the percent initial margin times the contract value, which is the quantity of the foreign exchange, times the futures price of the foreign exchange. So if the initial margin percent is 5%, and they're going to buy 500,000 euros at a forward price of $1.2228 per euro, cross that out, what you'll see is they'll need to deposit $30,570 in a bank account at the exchange, at their clearinghouse, they call it. And this amount is not really a cost, it's just a security deposit, and it'll actually gain interest. Now, once you're in a position with the futures contract, your margin will change daily with the profitability of the contract. So here's an example where someone takes a long position in 2 euro contracts, each one's for 125,000 euros, at a futures price of $1.25. And say the initial margin percent was 8%. So they'll pay 8% of the contract value. Notice there's 2 contracts. So this person will deposit $25,000 at the exchange, and that's their margin or bond requirement. Sometimes it's called a bond requirement because you could deposit, say, $25,000 worth of treasuries to meet margin. Now, on a daily basis, this is going to go up and down. The first reason it's going to go up and down is it's going to go up every day simply for interest. So say one day later, Nothing happens. However, the exchange promises a 4% APR, annual percentage rate interest, compounded daily. So if I had $25,000 at the exchange and I'm getting 4% per year, I'm going to get about $2, that's what it amounts to, of an extra couple dollars in my account every day. However, there is a daily settlement or daily mark-to-market profit calculation at the exchange. And that is, if you are long, you take the change in the futures price times the quantity of euros. And that will give you a daily profit. It's as if you went long at, say, 125, and the futures contract the next day, this exact same contract is now trading at $1.26. They'll say, well, you're ahead in this contract. You went long, kind of betting that the price would go up, or took a position that would benefit if the price goes up, and the price went up by a penny. So we're going to deposit an extra penny times your 250,000 contracts. So we're going to give you that money in your account. So here's the example. After going long one day at 125 for 250,000 euros, the futures price goes from 125 to 126. Your margin balance goes up by the interest, a couple dollars. Then the change in the futures price of 1 penny times the 250,000 euros, which is 125 times 2, you pick up another $2,500 in your account. And so what you see is you now have 27,502 in your account. You can actually withdraw that change. You can withdraw everything above that initial margin. So the one benefit of a futures contract, if you're, say, using this contract to speculate that the euro would appreciate, and say December was 3 months away at the time you took a long position, if tomorrow the euro does start to appreciate, you can take an immediate profit home. You can withdraw that extra $2,500. But it goes both ways. If the euro would appreciate, this actually may drop below 25,000. The margin balance may drop below 25,000. And what you'll find is at some point you'll get a call called a margin call when you drop below the maintenance margin percent, which is generally, say, about 80% of the initial margin. Now, if you were to, say, take a profit in this futures contract, you could lock into this profit by taking an offsetting trade. So I might be betting that the euro is going to appreciate between now and, say, December, which is a couple months away. And then I see tomorrow the futures price actually increased. I made $2,500. I could then close out this position by taking an offsetting trade. So if I went long on this day, I made some money, I could go short on the same contract. Now at the exchange, I'm now a buyer at 125, and then I'm a contractual seller at 126. And they're not going to make you wait around to December. They'll just give you a check for that difference, and you're effectively out of the contract. We call that unwinding a contract. Again, a futures contract is not an option. You can't just walk out of it. But if you do have a gain or a loss, you could take an offsetting trade, say go long initially, then go short the next day or next week, and you're effectively out of the contract. So if you go long in a position at F0T, so say that's today, you're contractually obligated to pay the futures price. If tomorrow you then take a short position to get out of your position, say tomorrow is date little t for still December delivery, you can get out of the position and your profit would be this difference times the quantity. If you're short, we just take the negative of that payoff function. If I initially go short at F0T, that means I'm contractually obligated to deliver, say, euros and receive the futures price. I could go long the next day and a commitment to buy at this futures price, and therefore I am now out of the contract. I have a contract to first sell it and then buy it. I'm out of the contract. So here's an example. You go short on Monday morning at a price of 93.7 cents per euro. So you're short at 93.7. If the price goes down, you should win. If the price goes up, you should lose. In the afternoon, it does go down. It goes down to 93.15. You'll see you could then go long in the afternoon. All right. So again, this contract may be a year away from delivery. I go short in the morning at 93.7. In the afternoon, that futures contract is trading at 93.15. I made some money. Actually, the difference, 93.7 minus 93.15 on 125,000 euros, is $687. I could then just walk out, take my $687 in profit, and I'm out of the position. I'm unwound. That's why we say that futures contracts have liquidity, and that's an advantage over a forward contract. You could always get out of the contract. You cannot avoid gains or losses, but you could effectively take those paper gains and losses and get out of the contract by trading it. So just a little poll here. Suppose you take a long position in 5 yen futures. So you're long in 5 contracts at a futures price of 78 yen per dollar. What's your profit if you unwind your position when the futures price is 80? All right, so in this case, you went long at 78, right? The word long implies that you're going to benefit if the price of the yen appreciates. However, remember, this is an indirect quote. So in order for the yen to appreciate, this actually has to go down. The dollar price of the yen actually, the yen price of the dollar actually has to go down. What you see is at the end of the day here, the yen is trading at 80. So actually, you're going to be showing a loss because you're betting on an increase in value of a yen, and it actually depreciated. If each contract is 500,000 yen, I can do my profit function. The profit from a long futures contract is the change in the futures price, went from 78 to 80, times the quantity of euros, say 500,000 yen times 5 contracts. However, for this math to work out, if I have 500,000 yen times 5 contracts, I need $1 per yen change in the futures price in order for these yen to cancel out and give me $1 profit. So be careful when calculating payoffs and profits from indirect currency forwards and futures. This quantity is always going to be a quantity of foreign exchange. These values are always going to be dollar per foreign exchange. So let's just summarize here on the liquidity and unwinding of futures contracts. Why would you unwind your contract? One, it's to lock in a gain or loss. Say you're betting on the euro is going to appreciate over the next month. However, if it happens tomorrow, I could just take my gains by taking an offsetting trade. Secondly, you could avoid delivery. Say the contract is near expiration, say next week. However, the contract requires that the euros be delivered to New York. You could just get out of the contract by unwinding, take your profit, and you could buy or sell euros wherever you'd like to buy them or sell them. And lastly, a very important point is with a futures contract, you can adjust the timing of the futures contract to changing timings in, say, a receivable or payable. So let's go back to our Dell example. Dell expects a receivable, say, to come due in December. But now you're sitting and so you go long the December, or you go short the December futures contract. So you short the December futures. So it looks like you're hedged. However, this then moves to March. If this were a forward contract, you're really stuck. You could ask the counterparty to change it, but you're really stuck. So what you could do is you can go back to the exchange, go long the December contract, which effectively gets you out of this one, and then go ahead and short the March. So you're effectively adjusting the timing of your hedge. All right, so that is futures contracts on currencies.